Everyone, my name is Ryan, and today we are talking about the top 3 things that you must know before you apply for that home mortgage loan. Now, I am pulling this information from my new show, the Curious Realtor Podcast. Link will be in the description if you want to check it out. And I talked to Karen Bartholomew, a 17-year vet in the mortgage industry. She is a branch manager and mortgage consultant at Summit Funding in Livermore, California. Now, these are just a few tips that you want to watch out for before you apply for your mortgage loan, and these could make a huge difference in preparing yourself for that mortgage loan. So as a first-time home buyer, it is very important that you watch this to the end to make sure you are doing everything correctly. Now, the 3 things that I want to highlight is your credit score and how to improve it. 2, your monthly payment and your budget. What does that look like for you, and do you know what it is? And 3, your short-term versus long-term goals. Are you setting yourself up for financial success in the years to come? So, I'm excited to get into all of it. Let's get started. So the first one is really important, and that is clean up your credit. It is so important that you have your credit score as high as you possibly can so you can get approved for the loan that you want and you deserve. Now, Karen gave us some great tips on how to get your credit score up if it is low. She didn't go into specifics on how high it needs to be as far as numbers go because it's individual for each situation. So, if you have a poor credit score, you really want to watch out for those monthly payments that you're leaving on your balance. If you have a $5 or $10 monthly balance that's left over after you pay it, 1, that's earning interest and you're going to be paying more for that purchase in the long run, and 2, those small balances left on your monthly statement could impact your credit score by up to 100 points. I was shocked when Karen expressed this to me because I thought leaving $5 or $10 on your monthly statement was okay and it could affect your credit score by a couple points. I didn't know that it could affect it up to 100. Also, another tip that Karen expressed to me was make sure your balance doesn't reach your maximum too often. Say you get a Macy's credit card, a Visa credit card, and you have a $5,000 credit limit. Well, you get your stimulus check, you're feeling pretty good, you go out and buy a bunch of clothes. Pretty soon you have $4,700 on that credit card statement. That is about to reach your maximum amount of $5,000. In Macy's and your credit card provider's eyes, you are a bigger risk and your credit score could drop from this. So you don't want to do anything that's going to decrease your credit score because it is so important that you have a good credit score when a lender looks at your records. That's going to determine how much they're going to lend you and how much of a risk you are with their money. So even if you have a few dollars on that credit card, pay it off. It's going to pay dividends in the long run and you're not going to have to worry about it. What I do personally, and you can do also, is as soon as you buy something, go ahead and transfer that money over to that credit card to pay it off immediately. You don't have to wait till the end of the month to pay your credit card off. That way you don't forget about it and you're not worrying about if your credit score is going to drop or not. Spend wisely, and when you do, use that credit card and pay it off right away. If you want to, there's always the automatic payment options, which Karen mentioned. Don't set up your automatic payments through your bank, set them up through the website that you got that credit card. So if you have an Amazon credit card or a Macy's credit card, go to Macy's.com or Amazon.com and set up your monthly payments there. That way you're making sure there's no delays in your monthly payment and you're paying it off every month in full without question. The next thing we're talking about is your monthly payment. What is that going to look like for you every single month for that mortgage? A great tip to keep in mind from Karen is making sure that your mortgage does not exceed 25% of your monthly income. That means if you're taking in $10,000 a month, your mortgage payment shouldn't be more than $2,500 of that $10,000, okay? Keeping your mortgage payment at a quarter of your income is going to allow you to have money to save, invest, buy groceries, clothes, and other necessities that you want in your life. So make sure your monthly payment is not more than a quarter of your monthly income. If you really want to get detailed and find out how much you can afford before you go see a lender, there are great sites like usmortgagecalculator.com, which I will link below. I'm not affiliated, it's just a good idea of what you can afford so you have a range of houses you can look in within certain price limits. So once you did a little homework yourself and you know what your monthly payment is going to look like, bring your budget, your income, and your bank statements with proof of funds for a down payment to your lender so you can get pre-approved. The lender is going to look at your interest rates, your income, your credit, your debt to income ratio, which basically means how much of a risk are you if we lend you this money, and your down payment size. How much do you have saved up in a 401k account or other investment accounts that can be used as a down payment for a home? Then you can start looking at homes because you know what you can afford and what you cannot. You're going to waste your time, your realtor's time, and everyone else's time if you go out, look at houses without being pre-approved, just to get let down when you find your dream home because you can't afford it. Don't put yourself or anybody else close to you in that situation. Do your homework and then get pre-approved with a lender before you start searching. So the third tip once you're pre-approved is making sure you understand your short-term and long-term goals. Karen brought this up, and it is really smart to know what your short-term and long-term goals are so you make the best purchase for your situation. You see, there's two types of buyers. One buyer is going to buy the home and stay in it forever. He's going to die in that home, all right? You're not going to be able to move him out of that home. So that's the first type. The second type is a buyer who, this is not going to be their last house, right? Maybe they're buying a condo or a smaller single family home, and they're going to upgrade or move up in about 4 to 5 years. The first buyer, we're looking at our long-term investments. They're buying this property and they're going to live in it, build a family in it, extend if they want to in square footage and whatnot. They're in it. So you want to make sure if you're in this position to buy a home in your 100% without a doubt desired location. You don't want to budge on location if it's going to be a hindrance to you in 3 to 4 years or even 10 years. You're staying in this property for a long time, so don't budge on the location. Get the house in your desired location no matter what. The second thing you want to watch out for if you're buying long term is making sure that you have enough space. And if there isn't enough space in that house already, does the lot that the house sits on have room to improve? Are there any city ordinances that prevent you from extending that kitchen that you want or adding another bedroom? Also, a homeowners association or an HOA may prevent you from adding or modifying anything to the exterior of your property. So you want to make sure your house has no HOA limitations and it has room to improve or upgrade if you want to extend later on and build more on that property. People who are going to buy long-term are generally people who want to build a family, or we're seeing a lot of multi-generational families buy bigger properties and holding them long-term. Now the second buyer is our short-term buyer. This may be their first house they are buying, but it definitely won't be their last. So location may not be such a big deal, right? You want to be close to work, you want to be close to the necessities. However, if you can find something for a little bit cheaper in great condition, then you could probably move in that property knowing that you're going to upgrade to a bigger house or one more suitable for you in the near future. Now, when you're in this position, you also want to watch out for buying something that is in great move-in ready condition. If the home is not in move-in ready condition, you may need to spend money adding on to it or improving it. You want to make sure that these improvements, if there are any, are going to add more value when you sell it later on. You also want to keep in mind when you're buying for the short term, you don't want to buy something that requires a lot of work. You don't want to buy a fixer-upper, and you don't want to spend thousands and thousands of dollars of renovations just to not get any of that money back when you sell it in 3 years. You want to make sure that these small cosmetic fixes will give you value when you sell it later on. Thank you so much for watching this video. I had a great time making it and also a great time interviewing Karen. She is such an amazing person with a great positive outlook, and she really finds value and happiness in serving others. And that is what I'm attempting to do here with these videos and the Curious Realtor podcast as well. All I want to do is add value and give you guys more things to think about when you buy or sell your home. So again, thank you so much for watching. Please click the like button below. It helps me out, and subscribe if you want more type of this content every week.